1953. That's the year the 5-year bucket strategy ran a $1 million portfolio all the way to zero. Last week, I made the case that the 5-year bucket cuts retirement failure to about 3%. Then I backtested it against the worst 30-year window in modern history, the 1929 retiree. And the bucket failed. The strategy I disparaged last week, Bengen 60-40, finished the same 30 years with $500,000 still in the account. The aggressive bucket lost everything, and the boring rebalance won. That's a $500,000 gap from the same starting balance, the same withdrawal rate, and the same 30 years. So I owe you a correction. Today, we walk through the math of why the bucket failed and the 2 protocol changes that actually fix it. The honest fix. Let's run it. Picture every bucket study you've ever read. Almost all of them were tested against post-1985 data. The 40 years where bonds rallied, inflation stayed low, and every crash recovered fast. The gray line is what most retirement research papers actually tested, starting in 1985. Convenient and clean. The red line is the full history, including the part where stocks fell 89%. Goldilocks data gives you biased results. Every safe withdrawal study has this problem, and the bucket strategy inherited it. An 89% drawdown in the Great Depression. That's the single test that breaks every modern bucket strategy. There are 3 forces that break a bucket. A deep crash that takes out the year 1 equity, a second leg that hits before the recovery is even complete, and then a multi-year inflation regime that eats away at the cash bucket in real terms. The bucket protects you from one of those forces, but not all 3 at once. And when all 3 stack on top of each other, which is exactly what happened from 1929 to 1947, the bucket runs out before the recovery ever arrives. And here's the twist. The killer wasn't even the Depression. It was World War II inflation. Cash returned negative 17% in real terms in 1946 alone, and the bucket just starved. So next, let's walk the year-by-year timeline and watch the bucket die in slow motion. One quick framing note. Every number in this video comes from public data sets. Robert Shiller's online data, Aswath Damodaran's historical returns, and the Ibbotson SBBI yearbook. Sources are listed at the end. No fluff, no affiliate push, just clean arithmetic on real data. Now let's watch it fail. The bucket dies in slow motion. 24 years from the market peak all the way to zero. Each step looks survivable on its own. But stack them, and they aren't. We start in October of 1929 with a $1 million portfolio, 56% in equities, 24% in bonds, and 20% sitting in cash for the bucket. The retiree pulls $40,000 a year, the standard 4% rule. Years 1 through 4 are the crash. The total portfolio falls from $923,000 all the way down to $635,000 by 1931. And the equity sleeve shrinks to just $221,000. But here's the surprise. With deflation as a tailwind, the cash bucket actually grows in real terms. From 1929 through 1932, cash earned positive real returns of about 5%, then 9.5%, then 14%, then another 9%. That's deflation doing the work. The bucket actually grew in purchasing power. This is the part the modern studies completely miss, because they assume cash returns zero in real terms. By 1936, the recovery is complete, and the total portfolio is back up to $824,000. The bucket worked. 3 full refills from 33 through 36. The protocol did its job. Then 1937 hits, and equities drop 35% in a single year. The bucket is full, though, so the protocol holds. The total ends the year at $695,000. Still survivable. Then World War II arrives, and inflation rips through the cash bucket. In 1941, cash loses 8.7% in real terms. Then another 8.5% the year after, 16% in 1946, and 11.5% more in 1947. The bucket is starving. That's 4 straight years of negative real cash returns, averaging double digits. No cash bucket can refill faster than inflation is draining it. By 1946, the cash bucket hits zero. The protocol kicks in, and the retiree starts tapping bonds. Bonds at that point are sitting at $270,000, about 3 years of withdrawals. The fight isn't over yet, but the buffer is gone. By 1953, every bucket is empty, 24 years from the peak. A forced equity sale of $37,000 in the last year drains the equity sleeve to zero, and the portfolio is done, 24 years to zero. The retiree was 89 years old. Statistically, still possibly alive. Definitely broke. There are three structural reasons the bucket failed. The math is honest and the strategy has gaps. Both things can be true at the same time. Flaw 1 is that the bucket protocol explicitly says never sell equity in a down year. But the hidden cost is that you also never buy equity in a down year. You skip the buy low mechanic completely. Bengen 60/40 rebalanced every year. By 1932, bonds had returned about 17% in real terms while stocks were down 40%. The rebalance trade automatically sold bonds and bought stocks, at the bottom. That single move generated about a $420,000 advantage from 1932 through 1936, just from buying stocks at the bottom and riding the recovery. The bucket protocol forbids that move, and that's the single biggest reason it failed. Flaw 2 is that the bucket assumes cash holds its value across the holding period. That assumption holds in peacetime. It collapses in war or in any kind of monetary regime change. Watch the line. In peacetime, cash earns a positive real return. But from 1941 onwards, you get 9 straight years of negative real returns. Cash is not a regime-resistant asset class. Flaw 3 is that the 4% rule is rigid. $40,000 a year, every year, whether the market is up 40% or down 40%. Same dollar amount, same demand on the portfolio, no matter what's happening. The fix is a withdrawal rule that flexes. You spend a little less in down years and a little more in up years. That's Guyton Klinger guardrails, the rule that catches what Bengen missed. So that's 3 flaws and 2 fixes. The good news is, both of those fixes were already available to the 1929 retiree. Bengen didn't formalize the 4% rule until 1994, and Guyton Klinger wasn't published until 2006. But the math is timeless. So let's get to fix 1, the flex withdrawal rule. This is the single change that saves the strategy. Replace the rigid 4% rule with Guyton Klinger 10% guardrails. This is the single most powerful change you can make to a withdrawal protocol. There are 3 rules. First, you rebalance every year. Second, if your withdrawal rate ever climbs above 5.5%, you cut spending by 10%. And third, you freeze the inflation adjustment in any year the portfolio fell. 3 simple triggers, and all of them mechanical. With the rigid 4% rule, the bucket gets depleted. That's 100% failure on the 1929 path. Apply Guyton Klinger to the exact same path, and the portfolio survives, with $612,000 still in the account at year 30. One protocol change took us from total wipeout to over $500,000 in the bank. The catch is that in bad years, you have to spend less. In 1932, you cut 20% of discretionary. In 37, you cut again. And in 46, you cut one more time. 3 cuts across 30 years, that's the price of survival. Under the flex rule, the average spend was $36,000 a year, about 10% less than the rigid retiree pulled. But that's for the full 30 years versus the rigid retiree who spent $40,000 for 24 years and then nothing. Add it all up. The rigid retiree spent $960,000 over 24 years before going broke. The flex retiree spent $1.08 million across the full 30. So even though the flex year is smaller, the flex lifetime actually outspends rigid by about 12%. Smaller years, larger lifetime. That's the trade flex makes, and most retirees grab it the moment they see the math. Pfau ran a stress test in 2024. Guyton Klinger plus annual rebalancing came in at a 2% failure rate across every 30-year window in the modern dataset. That includes 1929. It includes 1973. It includes 2000. That's about 15 times better than rigid 4%. The strategy itself is free. The discipline is the part you have to bring. The second fix is to add an annual rebalance trade. You replace the bucket's never sell equity rule with a force buy low rule. This is the boring discipline that beats every clever protocol. You can drop the cash bucket entirely or keep it small for psychology. The real defense is a 25% bond sleeve with annual rebalancing. When stocks fall 30%, the rebalance trade automatically sells bonds and buys the dip. Rebalance equals buy low. It's mechanical. No emotion, no timing, just a simple calendar trade. Here's the calendar. Every January 1st, you review the drift. If your allocation has moved more than 5 percentage points from target, you rebalance. Otherwise, you do nothing. One decision per year. The rest of the year, you ignore the market. Just the 1932 rebalance trade alone generated about $280,000 in value across the next 20 years, all from buying stocks at the bottom. One trade, on one January morning, ended up being worth about a quarter of the entire lifetime portfolio. The old rule said never sell equity. The new rule is never chase equity. The right rule is really never sell at the wrong time and never buy at the wrong time. Rebalancing handles both ends of that. Stack the failure rates across every historical path. The rigid bucket dies on the 1929 path. Bengen 60-40 fails about 10% of the time. And flex withdrawal with the 75-25 split and annual rebalancing comes in at just 2%. That's the compounding effect of two simple rule changes. Two rules, and you end up about 5 times safer than Bengen, and 50 times safer than the rigid bucket on the worst path. Boring, mechanical, and effective. You can drop the cash bucket entirely, or keep 1 year of cash just for psychology. The real defense is the bond sleeve plus the rebalance trade. Once you've got both of those, cash is basically decorative. 3 moves you can make tonight. First, replace your rigid 4% withdrawal with Guyton Klinger 10% guardrails. Second, set a calendar alert for January 1st to do your annual rebalance. And third, drop your cash bucket from 5 years down to 1 and move the rest into a 25% bond sleeve. That gets you to a 2% failure rate, including the 1929 path, including 1973, including the path that broke the original strategy. Discipline is what protects you, not the bucket. The boring rebalance trade beats every clever protocol I could write a video about. If this honest correction was worth your time, hit subscribe. I publish a new one every single day. Secure your license to chill. Fix the wealth drain today. Wealth.